Good morning, everyone, and thank you for joining us for this webinar regarding internal controls. I'm just moving around some technology stuff so I can show it to you effectively. Okay, so internal controls. It sounds a bit technical when I think about it, right? It's like a big term. Really what it means is having control over our organization operation internally, right? This is processes that we have in place that help us control the operations, that help us feel in control. So kind of important, right? So when we say processes, again, it may sound technical and maybe boring, but really it refers to those useful things we have in place to prevent error and to prevent potentially mismanagement or fraud, right? So most of us have internal controls in our day-to-day life, actually all of us. So for instance, we have to pay our hydro bill on time every month, right? And if you're like me, sometimes I forget things. So in order not to forget to pay my hydro, I have this pre-authorized debit, so it comes out of my bank account. So having a pre-authorized payment is a process. It's a sort of internal control that makes sure my hydro gets paid on time and I don't get to talk to their collection department, right? It's the same thing with my credit card. That actually happened when I forgot to pay it by the deadline, and then you all know what happens is they charge you interest for the whole month, and their interest is not low amount, right? So it's very frustrating when it happens. And what I had to do is to set up a reminder, an email reminder that comes every month to say your credit card payment is due in 3 days. I'm sure many of you do the same thing, which is a smart thing. That is an example of internal control, where I have a process that makes sure I pay my credit card on time. Okay. So the same goes about our organizations. Those processes, they may not be necessarily the same, but they accomplish the same goals. They make sure our assets are safe, all our resources are spent in the way they should be. They make sure our risk of error, our risk of fraud are minimized. So internal controls are processes designed to prevent fraud and error. They're an important part of good financial management. It's important we don't rely on trusting our coworkers exclusively. It's good to implement processes that will prevent fraud and error. And this is because while majority of people are honest, sometimes life circumstances change and we're not in control of other people's life circumstances, right? And if we don't have processes in place that make it difficult to commit fraud or cause an error, those instances of fraud and error will happen. In fact, anytime we hear about fraud on the news, in the newspaper, or you hear about another organization, or from your friends, this is an instance when internal controls in the organization weren't good. Because if you have good internal controls, your risk of significant fraud or significant error is minimal. Okay, so I'll give you an example. One of my First Nations, we have a director of finance who's a very competent lady. She's well-educated and a good worker. Unfortunately, she's been sick for a while. And sometimes when she's very ill, she's not quite in control of what's going on. We were working from home during COVID, and it happened that her son developed a drug addiction. And so what happened is he got access to the First Nations checks, to blank checks, wrote some checks to himself and deposited them in the bank, right? And nowadays banks have automated processes for checking signatures. So unless your check is over a certain amount, which is like $20,000, $25,000, it will go through and may not get flagged by their fraud department. And that's been happening for about a month until we caught it. So what happened there? Well, because of the circumstances, she was not on top of her things, and the checks, the blank checks, weren't locked in a safe location, so somebody could access those checks and cause some grief to her and to us and to the bank. Okay, so now internal controls protect the organization, but they also protect the employees and leadership. Okay, so for instance, sometimes we have an executive director that runs a certain department, and then for whatever reason, rumors start happening saying, oh, she is doing whatever she wants in that department. Nobody even knows what she spends money on, right? If there is a proper internal control, meaning every expense, every check requisition is approved by somebody from the leaders, there is somebody from chief and council, reviews every expense, especially over a certain amount, signs the check, there is dual signature on checks, right? Then technically that employee is protected, because the response to those rumors is simple. There is management oversight, there is leadership oversight here. Everything I do is being checked, is being verified, is being authorized. In addition, if there is a budget that's been approved by leadership in that department, and the the department manager is running the operations based on the approved budget, again, she's protected because this budget was approved by the leadership. She's basically told what to do within a program in that budget, and she's been following it. In addition to that, we all know that chief and council or organization leaders have a lot of rights, but also everything that happens in an organization is their responsibility. The responsibility comes with the rights. So with a proper internal control, in my example, when a department manager has a lot of autonomy, a lot of power, in a proper environment, when there is leadership oversight, there is an approved budget, there is second signature on checks and check requisitions and all payments, right? And there is, review of the records, the leadership are working to fulfill their duties, to fulfill their responsibility. So really, those internal controls, they protect the executive director or the department manager, they protect the organization, and they also protect the leaders because everybody is doing their part, okay? Internal controls can be at the entire organization's level, or they can be specific for a department. So department managers can set up controls in their departments. During an annual audit, the auditors will examine our internal controls as a part of their planning and audit work. And they would provide recommended improvements in the audit management letter. So it would look like, currently the organization doesn't log checks in a safe location, and anyone can have access to blank checks. And the recommendation would be to lock the checks in a safe location, right? So definitely, if you're looking for suggestions how to improve internal controls, it's definitely good to discuss it with the auditors and review the audit management letter just to see if there are any suggestions. Strong internal controls equals strong organization and strong leadership. When designing internal controls, we need to think almost like a criminal, right? We need to think, okay, what can go wrong? How can a fraud happen here? How can an error happen? And in what areas? Okay, so sometimes thinking ahead when nothing has happened is kind of difficult. But most of us came across some sort of a story, maybe within our organization, maybe within a different organization, maybe it was in the news. Something has happened somewhere, and it's always interesting to hear when these things happen, right? And we can learn from those stories from other organizations or from within our organization. So sometimes if it's difficult to think ahead how to protect our resources and establish good processes, we can just look back and say, okay, what happened and what did we do to prevent it from happening again? I'll give you an example. One of my communities has a grocery store, and in that grocery store, we noticed that our profits have been just way lower than usual, just way lower for a while, for like a few months. We started looking into it. We went and interviewed the staff. We reviewed different things. And what happened is some of the staff, two of the staff actually, were writing off products as expired when they weren't expired. And expired products, nobody really watched what happened to them, so they could just take free groceries home, right? And because they had big families, that instance became a big deal for the store because a lot of free groceries went home to the big families, right? So, while it is unfortunate and those employees had to lose their jobs, right? It gave us an opportunity to learn how to strengthen the internal controls. So we said, what can we do for it not to happen in the future? Well, from now on, all write-offs for expiration date or anything else has to be authorized by the store manager. So the store manager is the only one that can authorize those write-offs. And we also made a policy that expired groceries, expired products cannot be taken home by employees. They just get destroyed. Sometimes it's unfortunate, right? Because, some of these things are okay. Like if you have something expired that can still be used, maybe it would be good to use. But just for the purpose of not encouraging those assets or those groceries to be taken by employees, we had to have that policy in place. So again, what happened there is we weren't that great at looking ahead and thinking, okay, what can happen? Because sometimes people that commit that fraud, they get very creative, right? And it's hard to think creatively ahead if we're not looking to be the ones committing the fraud, right? But it's always good to take the current situation, whatever happened, and make the best out of it by designing controls so it cannot happen in the future. Okay, so let's look at a bit of theory here. Here we go. So this is what you learn in school. Internal controls have 6 main principles, which they all make sense. Authorization. Anything I spend within my organization has to be properly authorized, right? Documentation. Any transaction I make has to have proper documentation to support what happened, what was spent on, who authorized it. Reconciliation. So this is where we prevent errors, right? When we do our, say, bank reconciliations and we match transactions in our system to the bank statement, which is an external document, as long as transactions match, we know our records are accurate. So this is how we prevent errors. Another example is reconciling revenue from ISC that we recorded to ISC reports. If our revenue in the records matches ISC reports, we know the revenue is right? Security. So that relates mainly to assets, right? So another example from real life, and you'll see I'm a chartered accountant, and again, it was hard to plan for all this thing to happen, and we kind of always work with designing a new control when things happen, because so many things can happen, right? But in one of the First Nations, they ordered a bunch of building materials for housing renovations, and the materials were stored in the basically in the band office's yard. So there's a big yard, so all the materials were unloaded there and just kept there. And so a week later, half of the materials were gone, right? Because people would stop by and they'd see something they need in their house, and they would just pick it up and drive away. So what was happening there? Well, there was no security over the assets. So we had to actually move it to a fenced yard, put security in there, and have a process where anybody that wants to take some of the materials has to show authorization by the housing manager or by proper person. So in my example with blank checks that were taken and used for fraud, that's again an example of lack of security, because a blank check is an asset, right? And if anybody can access it, then we have fraud instances. Then we have separation of duties. So theory tells us it's good to separate who has access to assets and who can make changes to records. I'll give an example for this one because it's kind of a bit tricky to understand. I worked, actually did an audit for a company that had a receptionist. The receptionist would receive all the mail, and at the time customer checks came in the mail, so she would open the mail, she would get customer checks, she would prepare a bank deposit, she'd go deposit the checks in there, and at the same time she would update customer records in their accounting software. So she would record those customer payments in the software. So it happened that the receptionist had a gambling addiction, and she needed money. She became very creative. The company's name was ending with LTD. She went and opened up a company in the same name exactly, just ending with an Inc., and then opened a bank account in the new company's name. And she was using those customer deposits in her own fake company bank account. So she would use it for a while and then return some and then use some new ones. And that lasted for about a year until it got caught. And the only reason it was able to happen is because when she used the money in her own company, she was able to go and alter the records in the actual company's books, right? So if she received a deposit and used it personally, she would go in the records and record a customer credit in there. So when management reviewed what customers owe them, which they did on a regular basis every week, they wouldn't see anything owing, so nothing would get flagged. So separation of duties, or sometimes you'll hear it's called segregation of duties, would mean that if one person receives those customer deposits and goes to the bank to make a bank deposit, that person shouldn't have access to alter customer records. It should be a different person. So we want to separate between people handling actual assets and altering the records for those assets, if that makes sense. And now the last one is oversight, which refers to the management and leadership role. So the role is not to control in a micromanaging way. The role is to provide oversight, meaning approving an annual budget, reviewing records on a regular basis, quarterly or monthly, reviewing financial statements, maybe signing checks as a second signature, depending on the structure of the organization. So oversight is an important principle of internal controls. So we go through examples of good internal controls. So we have blank checks are locked in a safe location, right? We've talked about that for a while. And that would be the principle of security, asset security, securing the assets. Dual signature on checks. So that's a principle of authorization, right? We have proper authorization for our payments. Approval initials on support documentation prior to signing checks. Well, that's again authorization and documentation, right? We have proper documentation and we authorizing the expenses properly. Payroll should be reviewed and approved by executive director or department manager. It should be prepared by another staff member. So you want at least 2 people involved in the payroll process. So somebody prepares, somebody else approves. The most common internal control deficiency in organizations normally relates to payroll. When I was a young CA student, I went to First Nation. We did an audit. It was my first, I think it was my first audit, one of the first ones. And it was the first time audit for the firm I was with that particular First Nation. And what we found after looking through stuff and interviewing people is there was one person responsible for payroll preparation and nobody ever reviewed payroll. So that person has been around for over 10 years. She had full control over payroll. And it turned out that there were many employees on payroll that happened to be her family members that didn't really work for the First Nation, but they've been receiving payroll for years, right? So reviewing payroll, having a process where somebody, if it's not realistic for somebody to review every payroll, then at the very least, when you do your monthly or quarterly review by leadership or by management, review the payroll at the same time just to see who's on payroll, right? Ideally, every payroll should be approved by a second person in management or leadership. And by approved, it means they review it first, right? They don't just fully trust the payroll preparer. Board of Directors or Chief and Counsel review of internal financial statements. That's an example of oversight. Monthly bank and credit card reconciliations. That's example of reconciliation to prevent errors. Access to building materials secured. Release requires prior authorization. We talked about that one. Again, this is security and authorization at one, like in the same control. Employee timesheets are approved by their department managers, right? So another very common internal control deficiency is no one reviews timesheets and approves them. So one of my First Nation had an issue with that because the employees would be creating and signing their own timesheets and submitting them to payroll clerk for processing. And you know, our timesheet payroll got out of hand. It went from $20,000 biweekly to $45,000. This is when we had to say, okay, what's happening here? Again, looking backwards, but at least cashing it for the future. And then we noticed that there was no proper process of approving those timesheets, and they were processed as submitted by employees. Obviously, I cannot authorize my own timesheet. With the proper control, there should be my manager, department manager, or somebody on Chief and Counsel authorizing my timesheet. Mandatory annual vacation for all employees. So why is that here? Well, if somebody is to commit fraud, the thing they're gonna fear the most is that somebody else comes to do their job for a while and they'll learn what they did, right? So when you learn about internal controls at school, this is a classic example. If somebody never wants to go on vacation, that's a red flag, because why not, right? So having that mandatory vacation and having somebody else cross-trained so they can do the same duties is a good idea from many perspectives. Well, first, it's the fraud prevention control, and second, what if something happens to our employee and they can't work for extended period of time? At least somebody else knows how to do their work and can do it. Staff in charge of recording revenue should not open mail, receive customer deposits, and should not make bank deposits, right? So again, we're trying to separate access to assets and access to records. Because if I decide to commit fraud with the assets, I can always cover it up by altering the records, and we don't want that to be a possibility. Supporting documents for accounting transactions are retained for 6 years. So that's documentation, the principle of documentation, and 6 years is actually a requirement by all federal and provincial laws and Canada Revenue Agency. I have to qualify this one though, because IFC is still requiring 7 years for documents retention. So if it is for an ISC program, you want to retain for 7 years, not for 6. It can be electronic or paper, but it addresses the principle of documentation for internal controls. Okay, so let's go over good controls for expenses and payments. And I just noticed I'm not sharing with you, right? Okay. Here we go. So let's go through controls, suggested good controls for expenses and payments. Check requisition signed for approval by program supervisor. Dual signatures on checks. When signed checks, review and initial the supports and bill and or check requisition. Again, this is all authorization, right? Proper authorization control. Pre-signed checks aren't a good idea. If you have to use them, review issued checks at the back of bank statements monthly. So pre-signed just isn't a good idea because it opens up the possibility of fraudulent transactions like widely, right? Sometimes there's no choice. Sometimes the signer is away or they go on vacation and we can't have access to that. So somebody leaves pre-signed checks. So that's only acceptable if you have dual signatures, right? If you only have one signer and they leave pre-signed checks, now we're wide open to all sorts of fraud. If there is a second signer, at least somebody else is looking at it and signs it again. In either situation, if we have pre-signed checks, it's good to review what checks were made. If you grab your bank statement, at the back of the bank statement, there is photocopies of all the cleared checks, and you can just quickly review them and make sure nothing is out of order. That's a good process in that situation. Second person approval for electronic payments. Well, here is another one. Electronic payments are very common nowadays, right? And it may not be realistic for a second person to approve every single email transfer or every single EFT, but over a certain amount, it's a really good idea to have a second approval, just because nowadays you can send money anywhere, right? And once it's gone, it's very difficult to recover. We had a situation with one of the nonprofits I work with where staff were on Christmas holidays and the accountant received an email which looked like it was from the executive director. It came from her email address, was worded the way she would, and it was asking to send a wire payment for $15,000 immediately. It's urgent to a certain individual with an address. And so there was no way for the accountant to get a hold of the executive director because everybody is away on holidays, and it looked legitimate. So she made that one payment, and then 2 days later, she receives a request to make another payment of $15,000 to the same person. So that turned out to be a $30,000 fraud, but it didn't get discovered until after everybody were back from holidays. So they called RCMP, and the RCMP were actually able to find where the money went and that person, but it was impossible to recover because, you know, there's fraudulent schemes where it goes to a different country and there's no way to recover that. So what happened here? What did they learn from that? Well, just one person being able to make an electronic payment without proper approval, this is what caused the issue. If the executive director, it's a small organization, so the second approver would always be the executive director. If the executive director had a chance to look at that payment before it went out, she would absolutely see that she never requested it, that it was a fraud, and it would have never happened. So it's definitely a good process to have a second approval for electronic payments, wire transfers, EFTs, even email transfers, at least over a certain amount. Monthly bank reconciliations, again, to prevent error. Monthly credit card statement review and reconciliation. So it's actually the same organization that had another issue. Their credit card, they have multiple credit cards, different staff members hold them, and they were behind with credit card reconciliations by, I don't know, like 4 or 5 months. And there was a fraudulent charge on the assistant executive director's card of over $4,000 from Hong Kong. It didn't get caught by fraud department of the credit card. And by the time the organization, like the accountant, did the bank reconciliation and questioned the transaction, it was too late to ask the credit card company to reverse it, because they had a 60-day limit for when you could ask for a transaction to be investigated and reversed. So another good control is if we don't reconcile our credit cards on a regular basis, at least we should get people that hold the cards to review the statements on a regular basis to make sure there is nothing in there that needs to be investigated. Budget versus actual financial statements review. Again, this prevents errors, because if something got allocated to the wrong account, when we compare that category to the budget, hopefully we can catch that. Let's go over controls for assets. So we spoke a lot about the physical security of assets that can be moved easily, such as building materials or checks. We talk about checks. If you have cash transactions, such as a smoke shop or a grocery store operation, cash should be counted at the beginning and end of day by 2 employees and kept in a locked safe, and bank deposits should be made regularly. I think that's pretty straightforward. Inventory write-offs authorized by management. So that goes back to my example of the community grocery store and how a fraud can be committed through writing off some of the inventory. And blank checks are locked in a secure location. You see this is a theme here. Why is this a theme? Because I've seen many cases of those checks being used not properly. Again, the bank's controls, bank signature checks aren't really in place for smaller checks unless they look completely, completely different than usual. So it's most likely that if somebody gets a hold of a blank checks and writes something to themselves in a reasonable amount, it most likely will go through in the bank. Let's talk about financial controls for revenue. We want to minimize cash transactions. Cash is counted and reconciled to sales reports daily, and we issue receipts for all cash revenue. Well, cash, that's very straightforward because cash is easy to misappropriate, right? So we want controls over cash. You'll notice that when you fly on airplanes, they don't take cash payments anymore. And then you'd wonder what happened, right? They just want to take credit card payments. Well, it's just too easy to pocket the cash, right? Because if you buy something on the airplane, it's not like you're asking for a receipt, right? Make sure reports and requirements per your contribution agreements are all fulfilled on a timely basis to avoid fines and halts. Segregation of duties, we talked about that. Access to cash or customer payments and bank deposits. The same person shouldn't have access to alter customer records. And then budget to actual reports review. Again, we can catch misallocations and errors by doing the budget to actual review. Financial controls for payroll. Set up a hiring approval process, including position posting, interviewing and selecting candidates. Consider conflict of interest, right? So we want to make sure that our hiring process is transparent. And it also includes some background check, right? So if somebody has history of being dishonest at their previous position, hopefully we don't hire them. In addition to that, sometimes you have a history of taking the employer to court at every occasion, or calling the employment standards. So when we have a hiring approval and screening process, all these things need to be considered just to prevent issues with the employee in the future. Prepare employment agreements and document any wage raises. So this is important because actually number one legal issue, number one cause for lawsuits against most organizations, including First Nations, is employment related. So the more you document, the more you have in place to support that employee-employer relationship, the safer it is for the organization. Staff sign employee manual, right? Another thing where, you know, somebody starts missing work and we say, okay, you passed your vacation days and your sick days. Well, you never advised me what my vacation and sick days are, right? When they sign employee manual and their employment agreement, that's all a part of that. If they engage in some sort of unprofessional conduct and are disciplined later, if they sign an employee manual, they can't say, well, I didn't know this is not allowed, right? An example would be posting of some confidential information on Facebook, or maybe, you know, bashing other employees in the band on Facebook. It can be part of your employee manual, social media behavior policy. And if an employee signed that, now they have to act in accordance with it. And if they don't, you can discipline them and take actions, right? But if they didn't sign an employee manual, they can always say, I was never advised, this is not acceptable. And then we may be facing some sort of employment standard or lawsuit issue. Call labor board and band lawyer with any contentious employment issues to avoid wrongful dismissal costs. And again, any sort of labor law issues, I go to the lawyer because there is so many provisions, so many laws involved, and this is the number one risk area for lawsuits against most organizations. Payroll review by program manager. So we spoke about that, the second person reviewing payroll, reviewing who's on payroll and why they're getting paid. And then budget versus actual reports review. Again, we can catch allocation errors. If payroll is too high somewhere, we can also question that and request to review a list of employees who's getting paid. Okay. So the last one here is financial controls for leadership. Remember, it's the right and responsibility, the oversight over everything within the organization. So conflict of interest policy, right? We never want to be in a situation where somebody says, well, you know, as a leader, you prefer in your family, or you're giving this position to your family member. So with a conflict of interest policy, that's a strong policy and is getting followed, those kind of accusations are really meaningless, right? Now, if you don't have a conflict of interest policy, you can still use common sense there. So if the organization is hiring your family member, it's probably a good idea you don't get involved in those hiring processes. Like, you step back and let the other leaders handle it. Finance and investment committee with independent members. Elected leaders can be the majority. So this is a big area of concern or potential issues for many organizations, where there is the money coming maybe from some land settlement claims, maybe from bank financing and economic development investments are made, or maybe housing repairs. And those investments can be good, which is great. Everyone is happy in that case. Or sometimes they're not so good, not as good as expected. And if the decision is fully made by the leadership is the one to be blamed for the investment, for not so good decisions, right? And if you have a finance and investment committee with independent members and everything goes through it, this actually protects the First Nation or the organization, but also protects the leadership, because all the decisions are vetted by the finance and investment committee with independent members. Policy for making major decisions, investments and loans, requiring an independent review by 2 professionals, accountant and lawyer, and an approval by finance and investment committee. Again, it's the same idea. We're protecting the organization, but we're also protecting the leaders, right? Because all the decisions go through proper approval, through proper process. Professionals and independent committee members are involved. So if something happens and the decision turns out to be not so good, at least chief and council or leaders exercise good care and fulfill their responsibilities as leaders by going through proper processes. Policies are only as strong as the leadership's commitment to follow them. Well, that is self-explanatory. We can have a strong conflict of interest policy, but if we don't follow it, it's not worth anything, right? We can have a dual signature on checks, and when we sign, the second signature say by leadership, they have to review supporting documents. But maybe there is trust in place and they just go through checks and they sign one after another without checking. So again, the policy is good, but there's no commitment to the process. So the policy isn't worth anything if there's no commitment. Okay. So that's it for today. Thank you for your time.